The Bank of Japan just raised interest rates, and the yen fell. Think about that. They hiked, they trimmed bond purchases, and US dollar to Japanese yen is pressing 160.50 like the decision never happened. Most traders see a hike and immediately short dollar yen. That's the trap. There is one danger zone and one hidden opportunity right now, and I'll show you both. If you've been sitting on the sidelines, waiting for a collapse that never comes, you need to hear the exact level that flips everything. Stay to the end. I'm giving you 3 exact levels you can trade today, including the sniper entry that institutions are watching, the active pullback play, and a high-risk aggressor setup for those who understand the intervention ghost. Here's the live verdict. We're trending, and we are fading nothing. The session bias is unapologetically bullish. Price is holding a methodical stair-step above every major moving average on the hourly, the 4-hour, the daily, and the weekly. The trend strength reading, ADX, is sitting at 46. Anything above 25 is a trending market. Above 40 is an express train. You don't step in front of it. The only thing keeping this from turning into a full-blown melt-up is the 160.80 resistance wall and the phantom threat of verbal intervention. Write this number down. If we break and close above 160.80 on the 4-hour chart today, the entire structure resets, and the path to 162 opens in a single session. The herd is heavily positioned short, still faded from the BOJ headline. And their stops are building like dry tinder above that level. That's the liquidity that fuels the next leg. The single invalidation level that flips my bias is 159.19. A daily close below that voids the trend structure and would signal a genuine exhaustion. But right now, we are buys only until proven otherwise. Let's go top down because the larger timeframes are the ones screaming the loudest. On the weekly chart, the 200-week moving average is nowhere near us. It's way down at 156.27, which means the long-term trend has zero gravity pulling it back. The 20-week moving average is sloping upward at 159.77, perfectly catching every dip over the last month. Drop to the daily. The 60-day moving average is at 159.06, and the 100-day at 158.12. That spread is widening, telling you momentum is accelerating. The daily candle compression right around 160.40 is a classic coil before expansion. The MACD on the daily is printing a steady histogram above zero, no bearish divergence at all. This is not a market that wants to roll over. Now, here's what most traders miss. The 4-hour chart is giving you a hidden signal that's pure gold. While price has been grinding slowly higher, the 4HRSI has been hovering near 60, not overbought, just persistently bid. But look at the CCI, the Commodity Channel Index, reading 97.6 right now. It's kissing the plus 100 threshold without yet piercing it. That's a pre-breakout compression zone. The MACD on this timeframe is at 0.390, with the signal line flat. Not crossed bearish. There is no negative divergence. Buyers are not exhausted. They are reloading. The 20-period moving average on the 4H is 159.77, and every single pullback over the last 6 candles has bounced perfectly off the 10-period MA at 160.12. That's your intraday dynamic support. Right now the 5-period EMA is at 160.27, guiding price with a 10-pip cushion. The moving averages are stacked like a ladder, 5, 10, 20, 50, 100, 200, all pointing higher, no compression, just tiered support. Let's put the exact numbers on the screen. Pivot point for the day is 160.13. Support 1 is 159.86, support 2 159.46, support 3 159.19, that's the line in the sand I mentioned. Resistance 1 is 160.53, resistance 2 160.80, resistance 3 161.20. The 160.80 level is critical. It's the previous swing high from the last intervention panic zone. Above there, you're into thin air until 161.20, and then the psychological 162 handle. The stochastic is at 66.7, nowhere near overbought, leaving room to run. Williams percent are at minus 13.7 confirms the same. Near-term overbought is not here yet. Every oscillator is synchronizing for a push higher, not a fade, and there's a cross-asset linkage you need to see. Gold is moving tick for tick with real yields, but US dollar to Japanese yen is completely divorced from traditional safe haven flows. It's locked onto the Nike 225 and S&P 500 futures. Right now, risk appetite is firm, and the yen is being used as the funding leg of the carry trade. The equity markets are not breaking down, so the yen's defensive bid is absent. That's what keeps this trend brutally honest. Yesterday's Bank of Japan decision changed everything, but not in the way the textbooks say. They hiked 25 basis points, exactly as expected, and trimmed bond purchases. Yet the statement retained a cautious outlook, and Governor Ueda refused to commit to a rapid tightening cycle. The market heard that and immediately repriced the path of rate differentials. The US 10-year yield sits near multi-month highs, while the JGB 10-year is capped by yield curve control remnants. That 400-plus basis point gap is a vacuum sucking capital into dollars. The hike was priced in. The lack of hawkish surprise was not. So the yen weakened. Now let's talk about the intervention ghost. The Ministry of Finance's line in the sand has historically been around 160 to 162, but so far they've only used verbal jawboning. No actual yen buying. The market interprets that as a green light to test 162 unless US yields collapse, and they aren't. For the next 1 to 2 weeks, my directional lean is higher, targeting 161.20 first, then 162.10. The event that invalidates this lean is a sudden joint statement from the BOJ and MOF accompanied by an actual rate check, or a collapse in the US ISM services data that crushes the dollar. Absent that, by the dip. This is where I need your view. Do you think the dollar breaks 162 this week? Comment yes or no right now. I'm tracking consensus because sentiment is the final ingredient. If too many shout yes too early, we might get a liquidity squeeze before the real breakout. Most people skip this section. That's exactly where the money is made. Keep watching, because the difference between a retail entry and an institutional sniper entry is 3 pips and a whole lot of patience. I'm going to give you 3 strategies, each with an exact trigger, exact stop, exact target, and an on-screen trade card you can screenshot. Let's go. The sniper waits for confirmation that 160.80 has truly broken. This is not a breakout chase. The entry condition is a 1-hour close above 160.80, followed by a successful retest of that level as support in the following hour. So if we print a 1H candle closing at 160.85 or higher, then the next hour pulls back to 160.80 to 160.85 and holds. That's your trigger. Enter at 160.85. Stop loss goes below the Asian session demand zone at 160.20. That's beneath the pivot and the 20-period hourly moving average, giving the trade room to breathe. Take profit 1 is 161.50, just before the next intraday resistance cluster. Take profit 2 is 162.10, the big psychological magnet. Risk to reward on the first target is 1 minute and 1.8 seconds. What voids this setup entirely? A 1-hour close back below 160.50 before you're in, or a sudden intervention headline that causes a 50-pip spike lower. Patience is the edge, the sniper, conservative, entry, 160.85, 1H close above 160.80 plus retest, stop loss, 160.20 take profit 1, 161.50 take. Profit 2, 162.10 risk, air reward, 1:1.8R to TP1 invalidation, void if 1H close below 160.50, strategy 2, the active trader, standard. If you miss the breakout or want a higher frequency setup, the active trader buys the pullback to the pivot zone. The entry condition is a 30-minute bullish engulfing candle off the 160.13 to 160.20 region, with RSI bouncing from 50. That pivot is the floor today. Enter at 160.20. Stop loss is placed at 159.80, just below the S1 level of 159.86, protecting against a liquidity sweep. Take profit 1 is 160.80, the resistance that everyone is watching. Once price hits 160.80, move your stop to break even and let the runner aim for take profit 2 at 161.20. The risk to reward is 1 minute and 1.5 seconds initially, climbing to 1 minute and 2.5 seconds with the trail. The logic is simple. The trend is so strong that the first touch of the daily pivot almost always produces a bounce. The MACD on lower timeframes confirms momentum. This is the bread and butter trend following entry. Type your US dollar to Japanese yen range for tomorrow in the comments now. Let's see who's aligned. I want your high and low. The active trader, standard, entry, 160.20, bullish engulfing off pivot, stop loss, 159.80 take profit 1, 160.80 take profit 2, 161.20 trailing stop, move SL to BE after TP1 hidden validation, void if 30M close below 160.00. This is for traders who can lose small and manage risk aggressively. The aggressor is a counter-trend mean reversion short at the extreme resistance zone. We know the trend is up, so this is a scalp, not a swing. Entry is a limit sell at 161.50, with a stop loss at 161.75, extremely tight, just above the local high. The trigger must be accompanied by a 5-minute bearish divergence on RSI or a shooting star candle. Take profit 1 is 160.85, just above the broken resistance, and take profit 2 is 160.50, the prior consolidation high. This is a 1 to 3 risk-reward scalp that profits from the first intervention tremor or a simple exhaustion spike. Only take this if the position size is small and you're prepared to be wrong quickly. The setup is void if price slices through 161.75 without hesitation. Then the melt-up is real. The aggressor, high risk, entry, 161.50, limit sell, bearish 5M divergence, stop loss, 161.75 take profit 1, 160.85 take profit 2, 160.50 risk, reward, 1:2.6 R invalidation, void if 5M candle closes above 161.75 30-second pulse check. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact US session data or unscheduled MOF announcements. Stops are non-negotiable. This market can gap on intervention headlines. This is how you survive to trade the next big move. Protect your capital ruthlessly. The single most critical level for the next session is 160.80. That number separates a controlled grind from a full-blown panic melt-up. Tomorrow, all eyes shift to the US jobless claims and the Tokyo CPI print. That data could be the spark that lights the intervention fuse or kills the dollar bid entirely. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen, and I'll walk you through the liquidity tide that's moving everything. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one before the next explosive move.